We're going to wait just another minute. The room's starting to fill up. And when the number kind of stabilizes, then I'll start the seminar. Well, it looks like the numbers kind of stabilized. So let me start, and those who come in later will just have to catch up. So obviously, I'm not this good-looking fellow on the cover page. My name's Pete Knorr, and I'm a vice president and financial advisor at Bogert Wealth. And I'm going to cover the topic of discount rates and specifically how they affect the ExxonMobil lump sum. If you're not from ExxonMobil, it's okay, you're perfectly welcome. And most of what I'm going to talk about would apply to anyone, but when it gets right down to a couple of particulars, and I'll try to remember to point out which those are, it's really just ExxonMobil. So let me start out by introducing Bogert Wealth, if this happens to be your first exposure to us. So we are a registered investment advisor. I think of the investment advice world as in sort of two parts. One part is advisors who work for a bank, and then there are those who are independent of any bank. And we're in that latter category, a registered investment advisor. Now, our clients have money at a bank. Happens to be Charles Schwab, the first low-cost broker. And our clients then give us a limited power of attorney to be able to buy and sell in their accounts and transfer money among their accounts. And that's about it. So as a registered investment advisor, we are legally obligated to be a fiduciary, which means that we have to put your interest ahead of our own. If we have any conflicts of interest, we have to fully disclose those, act in good faith, have transparent fees, and all of that good stuff about being a fiduciary. Those investment advisors who work for a bank, sometimes they have to be a fiduciary and sometimes they don't, and you get one of them to explain that to you instead of me. So this is our team. We've basically doubled in the last year. So the advisors on the top row and everybody else is supporting the clients. For example, those who are focused 100% on managing investments, those who are focused 100% on the interaction with Schwab to get your transactions done. We also have a tax team, so we can give tax advice, we can do tax pro formas, and we can actually file your tax returns if you want us to. We have 3 locations. You can decide if they're convenient for you or not. Started in McLean, Virginia, just a freeway exit or 2 north of Gallows Road, if that means anything. When we realized Gallows Road was not going to be in the ExxonMobil portfolio for long, started hunting around in Houston, and then clearly have to have an office in the Woodlands. So most of the people are still in McLean. The Woodlands is the 2nd largest location we have. And then I'm out here in West Houston, pretty much all alone, but come visit me. So why would you pick Bogert? Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. So the intergenerational part is very important to us. And what that means is if your kids or your parents need financial advice, or you need help in managing their financial issues, which sometimes happens, we're here for that. So we are independent financial advisors. We can offer you some specialized analysis that most people can't, like NUA. Everything is pretty much customized to what you need. In-house tax optimization. Now, why is this interrupted? Oops, that wasn't good. Okay, folks, give me a second. I need to reconnect to the cloud. And that is not, all right. Did I say a second? Give me a minute. And even that's not going well. I might have lost my internet. It says I have no network. That's not good. Okay, it looks like I'm coming back on. Just another few seconds. Okay, so I got to share this screen again. So hopefully I'm back and hopefully you're still all here. And I should have mentioned, by the way, I have the chat open. I have the question and answer open. And so if you have questions, then let me know. So, okay, can you see my screen again? Anybody? Great. Okay, so our not very hidden objective in doing these webinars is to get you to come in for a one-on-one financial strategy session. Because in these seminars, we can talk about generic things, we can answer generic questions, but when it really gets down to how do these numbers actually affect me, we need to sit down and talk about that. So this is one of a series. Retirement planning timeline covers every topic having to do with retirement, but only about an inch thick. So the rest of these drill down into the more specific topics, retirement income planning, which is one of my favorites. So security strategies, tax planning, estate planning, NUA, and other post-retirement strategies. This one I'd say is 75% ExxonMobil-ish. Long-term care planning, Roth versus traditional 401ks and IRAs. So this is good for anyone, but particularly for the younger crowd. And then the mega backdoor Roth conversion seems to be popular these days. So getting into this particular topic now, how do discount rates affect my lump sum? Okay, so the going down arrow could be the rates going down, or it could be the lump sum going down. So we'll get to that in a minute. The first thing to say is there was a law passed in 2007, but developed in 2006, and it divides the world into two parts: the people who are covered under the law and the people who are grandfathered from the law. So basically, it limits a company's ability to offer a lump sum option. It basically says if they are not funded at least 80%, they cannot offer 100% lump sum. They can only offer a 50-50. And if they're less than 60% actuarially funded, they can't offer a lump sum at all. So this is one reason why ExxonMobil really is committed to keeping their pension plan funded, because all the executives really want that lump sum option. It defines the discount rates that can be used. So we'll get into that in a minute. It defines the actuarial table to be used. And we'll talk about the implications of that. It also allowed non-spousal beneficiaries to do rollovers, which kind of created the idea of a stretch IRA. That's not as big a deal as it used to be because of the laws that changed early in 2020. It also said after-tax balances can be rolled over to a Roth IRA. So that was new. It said the company match could be diversified. So this is when ExxonMobil no longer required you to put your company match all into stock in order to get the 7% match. Some people haven't caught up with that, by the way. So that's been around for 13 years now. And it defined IRA and 401k contribution limits and how they change with inflation. So who's grandfathered for the Pension Protection Act of 2006? This is the way the company defined it. You had to be over 50 by the end of 2007. And have, no, this is backwards. Oh, yes, have more, that's not backwards, have more than 10 years of service by the end of 2007. For those people, the old rules would apply. So they're exempted from, or they're grandfathered from Pension Protection Act 2006. So if you sort of put that into, why does that make sense? So that's, the law gave the company 5 years to get into compliance with the Pension Protection Act. And so 5 years would be the end of 2012. And so they said, okay, so if you can retire by the end of 2012, if you're retirement eligible by then, you're grandfathered, okay? So you back calculate what that means, and it means in order to be grandfathered, you have to be born before 1958, so 1957 or before, hired before 1998. Okay, so this is the one that's the real killer, is that, you know, you got to be like 63 years old this year or you're not grandfathered. Okay, so very few people left who are grandfathered, but for those people, they use 95% of the 30-year treasury bond, and then it's rounded to the nearest 0.25%. Okay. The other important thing, though, is they use the ExxonMobil 2000 mortality table. So they're like not able to update the mortality table. They're stuck with the one that they had at the time, which was the 2000 mortality table. So this is kind of what their discount rate has looked like. It's based on the 30-year treasury bond. And you can see that for a long time, the trend is down, even though, you know, there's some years in which it went up and other years in which it went down more profoundly. But definitely a downward trend, and definitely hit the lowest point ever. You know, I'm fond of saying when Christ threw the money changers out of the temple, they had a lot higher interest rates they were charging. But you see it's bounced up from that all-time low. So we take the data from any given quarter, there's always a dead quarter in between, and then it applies to the next quarter. Okay, so like right now, we're in the second quarter of 2021, and we're projecting the fourth quarter of 2021. And so you can see the data over here for April. You can see we're about 2/3 of the way through May, and this is as of last Thursday when we ran the numbers over the weekend. Friday's numbers aren't up yet. So then you can take the weighted average, and each day counts the same. So some people take the monthly numbers and average those. You know, they get about the right number, and when it's rounding to 0.25%, it's about the same. But if it's ever rounding right there at that rounding point, could go up, could go down, you better do it the right way and take all the individual days and they all count equally. So we're at 2.31 if you average all these numbers over here. 95% of that, 2.1953, and that is going to round up to 2.25, which is higher than the third quarter rate that we know is 2, which is higher than the current rate, which is 1.5, which is higher than the first quarter rate that was the lowest rate ever in the history of the 30-year Treasury bond, at least, and I would say pretty much of US interest rates. And then we can do further math that says, okay, how many days are left and what would it have to average for those next, in this case, 28 days to pop up or to pop down? And, you can see it started at 2.34. The last number we have is 2.34. It's gone down a little, but it's never gone down this far. And it's gone up a little, but it's never gone up this far. So, we're probably going to end up with 2.25. You can probably take that to the bank, although we still have a whole nother month to go and anything really could happen. So everyone else, which is probably the rest of you on this call, are subject to the Pension Protection Act of 2006. So that means you were under 50 back in 2007. It means you were born after 1957, or you were hired after 1997, possibly both. So in your case, instead of one single number, you're using something based on the high quality corporate bond yields, also called the HQM, high quality market. You can find them published by the IRS, and these are the numbers that matter. And corporate bonds are riskier than government bonds, so their interest rates are always higher, and that's bad for the lump sum, and we'll get into more precision on what bad means. On the other hand, they use IRS mortality tables that are released annually. However, a company does not have to change them annually. They're allowed to use the same one for 10 years. So ExxonMobil is still using the one from 2018, okay? Which is probably a good thing. Although I have not yet seen a mortality table that takes into account the fact that people over 65 were dying at higher rates in 2020. That one won't be good. But if you compare the 2018 with the 2000 mortality table, you got a couple of years of more life. And again, we'll get into exactly how much that matters. If you ask me which of these two are more important, I'd have to tell you the truth. The higher yields at this point are more important than the longer life. Okay, so this first affected pension plan participants in 2013. The data actually doesn't exist prior to 2013. And this is sort of what they look like going back to 2013. You've got these three segmented rates. Segment 1 represents the first 5 years. Segment 2 represents years 6 through 20. And then segment 3, the longer term bonds, represent everything beyond 20 years. And what I'm showing here is our model, which is the little boxes, versus the actual data. And if you kind of follow this along, you don't see anywhere in segment 1 where our model wasn't perfect, sort of yawn, because it's not the most important number here. The most important number here is segment 2. And you can see, here's the most obvious place where the model said interest rates were going down, and what got published said, well, yeah, but not as much as you thought, guys. Okay, so what I want to point out is the April number just came out last week. Why does it take 3 weeks to publish a number? And the answer is because they're not just tracking the market data. If they did that, they'd be able to publish it like the first day of the month, not the 21st day of the month. So they're doing backroom shenanigans, not really shenanigans, but they're doing a bunch of manipulation on the market data to come up with what they consider a smooth fit to the curve. And so we're not doing that because we don't know exactly what they're doing. What we're doing is following actual market data and looking for the trends in corporate bond market data. And so sometimes we're going to be a little bit off. And here's one where we even got the direction wrong. So this was in March, April of last year. So basically, here's March. Stock markets crash. Interest rates actually went up. And then the Federal Reserve comes in with buckets of money and the interest rates drop and drop and drop and drop some more. And somewhere in the middle of that, this isn't the IRS. IRS just publishing the number. The Treasury Department did the calculations and said the number went up instead of down. And I'll tell you, I'm still scratching my head on that. Okay, so that's sort of our ability to predict versus the actual numbers. So if you put it into a table then, these are all actuals, and this is the projection we're working on at the present time. And you can see that, you know, this one went down, 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 down. This one down and up a little bit and down and down, 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 and now back up. And this one again, down and now back up. It's hard for anybody to wrap their head around what does this really mean? How does this impact me? So what we do is we calculate a single rate equivalent. I'm going to explain that more in just a couple minutes so that it's easier to make comparisons like, well, from first quarter to second quarter, there's really no change. So first quarter to second quarter, this is the same. This went up a little and that went down a little. Okay. We said there's no change. From second to third quarter, big change, 42 basis points. You go, that doesn't sound that big to me, but just wait. I'm going to show you how important it was. If you're 60, 43 if you're 55. Now, why would that be different? Why would these numbers be different? Well, I'm going to show you. And then from third quarter to fourth quarter, we're saying, yeah, it's going to go up a little more, but you know, nothing like this move was. And as I said, these numbers don't really exist prior to 2013, but we use the same methodology that we use to do the projections and the same methodology that we do to get the single rate equivalents, and came up with this single rate history chart. Now, this is like daily numbers instead of monthly or quarterly numbers. So, you know, take this with a little bit of a grain of salt, but you definitely get the idea that these numbers can change. So here's 2008 financial crisis. Nobody wanted any corporate bonds because they weren't sure which ones had toxic mortgages in them. A little crazy, but okay. And then after that, they weren't sure which of these companies weren't going to go bankrupt in the financial crisis. So, okay, so we had a big perturbation here, but then down, 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 and then the Federal Reserve was increasing interest rates and then down. Here's 1 month of financial panic and then down. And here you see the pop up that gives us the second to third quarter result. And you see it's kind of, you know, down to stable as opposed to continuing to go up at this point. So that's why we're saying, yes, this quarter, a big move. we're projecting the fourth quarter will not be that big of a move. Okay. So now into how do all these things actually affect you? So the lump sum is the present value of an annuity. And I should say what's at the bottom of the slide first, that what I'm going to illustrate is a simplified example that will put in your mind the impact of age, life expectancy, and how the interest rates apply. This will not get you the lump sum down to the penny that the pension estimator gives you. Okay, so if you retire at age 60, you're expected to die on your 84th birthday. Okay, so you're going to receive this annual annuity through your 83rd year. And, you know, I'll admit, I back calculated what annuity it would take to get me a nice round number of $1 million lump sum. And that was $4,581.89, or about $54,983 a year. So there's my $54,983. And here it is discounted by 0.5%. So this one rounds up to, rounds down to 99%. And this one rounds up to 99%. But you can see they're different numbers. So I multiply the annuity payment by the discount factor. I get the present value of that annuity. All right. And year 6, you see there's a huge jump down in the discount factor. Now, let me talk about the word discount for a minute. So when you go into the store and you're buying something, you want a big discount. But in this case, the money's coming to you. You want no discount at all, okay? So the more the discount is, the worse that is for you. All right, now back to this jump from 97% down to 87%. So a lot of people are used to calculating a discount rate by just applying each year's rate to the previous year's discount, and that works, except in this case. So in this case, in year 6, what they're saying is, how much money would I have to invest today at 2.29% for 6 years in order to be able to pay out this $54,983 in the 6th year, okay? So that's why you have a big jump here. Now, you can use your simplified method all the way down to year 20 when you have another huge jump, because now they're saying, how much do I need to invest today at a 3.05% interest rate compounded for 20 years? And the answer is 29,256 in order to get the 54,983 in the 21st year. Okay. So then you add up all these present values, and that comes up to $1 million. So where did the 83 come from? That's your life expectancy to die on your 84th birthday. Segment 1, 5 years. Segment 2, years 6 through 20. Segment 3, 4, any years that are left. Now, the single equivalent rate is, what number would I put in here and be able to use the same number for all 24 years? The other way to look at it is, what is the internal rate of return of paying out $1 million today and then getting back $54,983 for 24 years? Either way, you'll get the same answer. It's 2.35%. Okay, so that's how we came up with what is the single rate equivalent for a person who's 60. Now, someone who's 55, so you put the number 55 here, and let's just for a minute assume they're also going to die on their 84th birthday, which is not really true. It's not really true because there's a possibility that somebody dies between 55 and 60. So if you take the benefit at age 55, your life expectancy is going to be a little bit less. But let's ignore that complication for now. The person is 55 instead of 60. There's going to end up being 5 more of these rows. Okay. And when there's 5 more of these rows, then instead of 4 years at the high number, you now have 9 years at the high number. And this is why younger people have a higher single equivalent rate in this table. It's always higher for younger people than it is for the older population. And if somebody was 65, it'd be even bigger deal because they're going to have no years in their actuarial life expectancy that it would apply the higher interest rate. Okay, so that is the interest rates for someone who has June 1st as their benefit commencement date. So now what about somebody who hangs around a little longer? And let's make the same assumptions, no change in the annuity, okay, but higher interest rates. So we drop those interest rates into this table, and instead of $1 million, we're getting $955. Okay. That's the difference between June 1st and July 1st, $45,000 less. Okay, and a single rate equivalent of 2.77. Now, a lot of people look at that and say, well, that means I'd be working for free for a period of time. So if your annuity is going to be $45.82, probably your salary is $10,000. Okay, probably about double that. I'm rounding off numbers. So that would say this person's working 4.5 months for free. And I hear people say things like that a lot. So I would say, well, you know, that's kind of true. But remember, this guy's 60. If you're not yet 60, then the longer you're on the payroll, and the longer before you take your benefit, you have less of that 5% a year reduction. Plus, the base annuity goes up by an amount that depends on how many years of service you have. So I talked to somebody a few days ago who has only 20 years of service. That means every year their pension is going up 5%. Okay. I talked to another person who has 25 years. Okay. Every year their pension's going up 4%. For somebody who hired on at age 22 and they're now 55, they have 33 years with the company. Every year adds another 3% to their pension. For somebody who has 40 years, okay, it's less than 3%, right? It's like 2.5% now per year at 40 years. So a person who's 60, this is a bigger deal than somebody who's younger. If you're younger, then these interest rate impacts are going to be attenuated by the reduction in the haircut for the early benefit and the increase, which is a bigger deal the less years you have with the company. Okay. All right. So let me generalize this. I'm going back to the retirement 2Q with the nice round number of $1 million. It's easier to see the impacts. And we're decreasing rates by different percentages up to 1. You know, 1% like puts that short-term interest rate in a negative territory. So I kind of hate even going that high, but okay, for mathematical purposes, we did it. And you can see that, you know, 0.01% decrease is a 0.1% increase in the lump sum, okay? A 0.5% decrease would be over 5%, and a 1% decrease would be over 10%. My rule of thumb, as interest rates change around, these numbers change around, and plus you see that the increased numbers are different from the decreased numbers. They're not mirror images. But my rule of thumb is a 1% change in interest rate is a 10% change in the lump sum. The first time I coined that rule of thumb was in 2006, looking at what was proposed for the Pension Protection Act and saying, how big of a change is this going to be for people's lump sum? And I said, corporate bonds are about 1% higher than treasury bonds. And so therefore, it's going to be about a 10% decrease in lump sums when the Pension Protection Act kicks in. I didn't know that I was going to be grandfathered from it at the time. And so, you can use that 1% equals 10% rule from 0 to 1. It's not really linear beyond 1%. Okay. So right now, with interest rates popping up, I don't have anybody asking this question about, well, should I retire and delay taking my pension? But some of you aren't anywhere near thinking about retiring. So let's cover this. When should you consider retiring but delaying the pension? And I would say, number one, you got to not need that pension money right away. Either you've got other savings that you've just been saving like in a brokerage account or just sitting in the bank, or you're thinking about using your 401k savings, for example. And a lot of people do that, particularly if they're retiring before age 60. So why is that? Before age 59 and a half, you probably already know there's a 10% tax penalty for accessing, withdrawing qualified money. Qualified money means an IRA or 401k. But there are exceptions to everything, okay? And one of the really, 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 really big exceptions is if you're talking about the 401k of a company where you separated service, and retirement is the ultimate separation of service. You separated service after the age of 55, you can access that 401k with no 10% tax penalty. Okay, so when they teach you the general rule and forget to tell you the exception, well, I remember back at ExxonMobil, I'd always say, what's the exception process? If we don't know the exception process, we don't understand the rule. Okay, so, all right, that's a big exception. And particularly if you're going to take the lump sum and you expect interest rates to fall, because now you might get a bigger lump sum. Plus, if you're not yet 60, you get that 5% a year, which really is 5/12% per month. Okay, every month counts. Now you might ask, why doesn't every day count? Benefit commencement is always on the first day of a month. And so that one goes by day. Now your years of service, if they calculate out the 4 decimal points, and if you think about it, 4 decimal points is less than 1 day. So now every day on the payroll definitely counts toward years of service. Okay. So this is a retirement roadmap. I'd show you one for June 1st, but it would be really silly. So let me tell you why that is. So this one's for January 2022. Pick any day you want. The logic of this should become clear. So we have 2 versions of this. One is the colorful one, and one is, I call this the engineer's version, and I'm an engineer, so I like this version. So basically, I expect my lump sum to show up on January 1st, okay? Back up from that, you have to have your forms into HR, notarized and everything, 35 days prior to your benefit commencement date. Why is that? Well, there's a federal law that says it's 30 days. And you can think of the extra 5 days in one of two ways. It's that ExxonMobil belt and suspenders approach to life. Or you can think of it as if there's something simple that they can correct in less than 5 days, you're still good to go. Okay. I like to actually think of it the second way because I fell into that category myself when I retired. So anyway, so you back up from that 35 days in advance, and then it's a question of how long does it take them to get the intent to retire package to you. Just as a trivia, when you request it, it's called the intent to retire package. When you receive it, it's the benefit commencement package. So it used to take 4 to 7 weeks, and they will still tell you it will take 4 to 7 weeks, but they changed something early this year. Early in 2021, they started being able to cough up these packages in less than a week in most cases. Now, if you're divorced and you have a quadro and that quadro needs to go to a third party law firm, it ain't gonna be a week. But for most people, I see them coming out in less than a week. So it used to be, if you expected this paycheck to show up on time, you darn well better be at least 90 days in advance. And 120 would be even better, okay? And when you request the intent to retire package, you have to give them 3 dates. What is going to be your last day on the payroll, your first day of retirement, your benefit commencement date. And I don't know why, last day on payroll makes sense. Benefit commencement date makes sense. And I think they want to force you to realize if your last day on the payroll has to be before your first day of retirement, that you cannot still be on the payroll December 31st. And yeah, anyway. So a question came up because someone actually read this that I didn't speak to, that the rollover check is delivered by old-fashioned US mail. And they asked the question, why can't they just send that directly to the financial advisor or the company you're going to have your IRA at, because you actually give them the name of that company in this package. You tell them that, yeah, I want to take 100% lump sum, for example, and I want it to go to an IRA at Charles Schwab, for example. And the check comes to your house, but the check is made out to Charles Schwab for the benefit of you. Why is that? I don't know, but I'll give you an example of someone that I thought was going to be a client. Helped them fill out the forms. They put Charles Schwab IRA on the form, and I never heard from them again. And I found out through LinkedIn that they were now a college professor far away. And so it's like, okay, something happened that made them decide, I don't want this to go to Bogert, but it did go to Schwab. But a Schwab account they opened themselves. So that gives you 35 more days to really think about what it is you want to do. That's about the only answer that I have. That why does the federal law require 30 days? And so I don't know. I assume always that, well, in case you wanted to not retire. But of course, these days, you don't really have that option anymore. Okay, so another question came in. Why does my supervisor have to know my benefit commencement date? You know, if I give them my last day on the payroll, that's all they really need to know. Okay, so that's a good question. And there's two different answers to that question, and they really are different. So one of the answers is that it is your timekeeper who actually starts the SMART form that gets the retirement process rolling, and they need to put those dates on the SMART form. So that's happening inside your group. And so that's kind of one answer to it. But the other answer to it is, don't worry about it. In order to get the intent to retire package and kick the whole thing off, you have to give them a benefit commencement date, even if you have no intention of actually taking the benefit on that date, because we're back here on you're considering delaying the pension. You're going to retire at the end of this year, for argument's sake, but you're not sure you really want the benefit commencement on January 1 because you don't know what interest rates are going to be doing for the first quarter of next year versus the fourth quarter of this year, okay, versus the second quarter of next year. So you want to wait and see, but you still have to give them a date. So it's like, who cares? Give them a date. And if it's the right date, great. But yeah, that's a good question. That's a good question. Why do they really need to know that? So, okay, what should you do now? Well, obviously, if all of this told you that, you know, you don't want to work for free for 4.5 months, then you should be putting in your intent to retire today. But if you're in that group of people who are like, okay, well, I was actually planning on working 2 more years, then you're going to be ahead a year from now, 2 years from now. So what you'd be doing now is working on your financial plan. And the most important part of the plan is the budget, and particularly your cash flow and anticipated future expenses. You know, are you going to move? Are you going to upsize, downsize, move to a beach front home? Are you going to work part-time? On and on and on and on and on. The budget is the most important thing. And usually the thing when I'm first talking to a client that they have the least idea about. They know their assets. Okay, so another question came up that says, okay, so my example where the person is last day on the payroll, December 30th, first day of retirement, December 31st, benefit commencement, January 1. And the question is, which quarter's interest rate is going to apply? And the answer is, it depends. Okay, so the hard rule is that the discount rate that applies is the discount rate in effect on the benefit commencement day. Okay, and for most of you, you can stop right there. That's it. So you commence on January 1, it's the January 1 discount rate. February 1, it's the same as the January 1 discount rate. March 1, that's also the same. April 1, it's now the April discount rate that matters. So the only exception to that is if your grandfather and you take the first available benefit commencement date, then you will get the benefit, you will get the discount rate in effect on your first day of retirement instead of the one in effect on the benefit commencement date. Okay. You know, like this applies to a vanishingly small number of people these days. So Yeah. So that's the one exception. And that's why we say further discussion is needed. Yeah, for a small number of people, further discussion is needed. For almost everybody, it's whatever is in effect on the benefit commencement day. And I think you can tell I'm kind of winding down. So if there are any more questions on this before I kind of hop into the what happens next? All right, well, I'll stay on for another couple of minutes. So we record all of these webinars that we do, and then we post them. I don't know about this one, you know, going dead for a couple of minutes in the beginning of it, but okay, we post them on our website. Go to bogartwealth.com, or, you know, you can just do a Google search on Bogart Wealth and then look for events, video events underneath events. Okay. If you are not already on the distribution list for upcoming webinars, then this is where you would subscribe for that, where it says subscribe for premium content. We're not even looking for a phone number. Okay. Email's good enough. You want to make sure we never bother you once you're retired. You give us your company email, and then maybe you look for us in Clutter or something. That's it. Okay. Then you'll get informed of future webinars. But if you miss one, you can always find it here. Now, the other thing is there's this contact us. Okay. You could use the contact us. Now we're asking for a phone number and leave us a brief message. And if your message says, don't call me, well, we won't. Don't worry about it. You know, we're really not in business to upset you in any way. So you could say, put me on your distribution list. For example, every week we put out an email with our latest guess, estimate, forecast of what the next quarter's interest rate is going to be. And as soon as we know the ones for a given quarter, we publish those as well. You could write in here, put me on your distribution list for interest rate updates. That would be a good use of that form. Okay. So I got two questions come in. The first one said, do I think there's still time to submit the HR smart form today and get the second quarter rates and retire May 31? Absolutely. And if you want more details, you can call me after the seminar. But absolutely, I've seen it before where somebody 3 days before the expiration of a rate said, I want to retire. This is in the old days when it took more than a week to get the forms. So they didn't get the forms until 6 weeks later. So it was a couple of months before they got their lump sum check. But there's no doubt that they got the benefit commencement date that they asked for. The check didn't show up on time, showed up late. They got a couple of months interest on it, which ain't much. But yes, there's still time to get the June 1 benefit commencement date. Okay, so now there was a question on, could I go over again how it is that we get that single rate equivalent? So there's two ways you can think about this, depending on whether you're an Excel person or more of a visual person, okay? But basically, this is how, knowing the annuity and knowing the interest rates, I calculated the present value of the annuity, and it came up to the $1 million. Now, in order to get this single rate equivalent, what I'm looking for is find a number that I can put in here that will give me $1 million of present value. Okay, so clearly it's going to be lower for the first 5 years and higher than shown here for the last 4 years. There's got to be some number that I can put in here. Okay, and so if you set up a table like this, then you can basically put in any number you want. I would start with a guess of 2.29 and then tell Excel, this is under data, what if, what's the final answer I want? Goal seek. And it's like, so you put in 2.29 for everything here. And you say, okay, so set this to $1 million by changing the number in this column, and it'll do it for you. Okay, so that's one way to do it. Another way to do it would be to say minus $1 million plus 24,983 for 24 years. What is the internal rate of return of that? That's going to be 2.35. So that is just a simple formula. So the first one is laborious and it uses a goal seek. The second one is a simple formula, IRR. And then, well, you got to get all of these in one column, or you got to work real hard to not put all of those in one column. But you have minus $1 million plus the 54,983, 24 times that range internal rate of return, that'll give you the number. Okay. And again, if that didn't make any sense to you, give me a call. I'll send it to you in Excel if you want. Okay. Any more questions? That's all my material and just about all my time. Well, okay. Thanks for attending. And again, hope to sign up and attend some more in the future at bogartwealth.com video events.